Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. There is so much going on right now with inflation and interest rates and job layoffs and the bond market, cryptocurrency, precious metals, and it's about time we had another edition of Clues in the News, the headlines, and what they mean to real estate investors. Today on the Real Estate Guys radio program. If you've been listening to the Real Estate Guys for a while, then you've heard about the legendary Investors Summit. Simply put, it's the highest level event we do, and the content, faculty, and attendees are amazing. If you're serious about taking your real estate investing to the next level, then join us next summer. You'll spend an entire week with like-minded investors, world-class educators, and real-world professionals, and you'll have a blast. It all begins June 6, 2023 in Ambergris Caye, Belize. Visit realestateguysradio.com and click on the tab that says Summit to learn more and reserve your spot. We'll spend a sun-drenched week learning and networking with more than 25 class sessions and breakouts, plus small format roundtable discussions, great dinner conversations, and a ton of fun. It's nearly 70% full already, but there's room for you if you go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys and an all-star faculty on the 21st Annual Investors Summit on Sand. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me in the co-host seat is our financial strategist, Russell Gray.
Hey, Robert.
It's a new year, and there is news all over the place. And from time to time, we like to do a show that we call Clues in the News. And we go kind of beneath the headlines to talk about how what the media is saying affects real estate investors. Now, we have to start with the preface that all media is not the same. And I think one of the things to point out, we have a lot of folks in our world that say, well, we don't listen to mainstream news. We try to look for different sources that are, more authentic. And we totally get that, by the way. And we often go to those very kinds of sources. But the big picture is a lot of folks are paying attention to the mainstream articles.
Yeah, well, we talk about this all the time at our syndication training because when you're out there raising money, you want to start from a conversational perspective, what people are already aware of and paying attention to. And so the first thing I always want to know is what is the most visited website for financial news? And it happens to be Yahoo Finance and has been for a long, long time. So I do pay attention to Wall Street Journal and Barron's and some of the places that typically more affluent stock market type investors go to. But I really spend a lot of time on Yahoo Finance because they are an aggregator and they pull things from all over, although they do have original content as well. And of course, to your point earlier, definitely spend some time on alternative news sites. I think you need to look at everything. You need to hear as many voices as you can. You need to get as many perspectives as you can. You need to verify that things that are being reported as fact are in fact factual. I think there's been a little bit of exposure on some of the facts and fact checking going out there, not being quite as factual as we would think it should be or would be. Obviously, maybe perhaps not so much of that goes on in the financial news, but there are political motivations behind how employment or interest rates or the health of the stock market, you can spin some things, other things you just downplay. But I do think it's important to pay attention to what Main Street is paying attention to, even if they're investing in Wall Street, because if you're going to make the argument either to yourself, to your friends and family, or to your prospective investors, if you happen to be syndicating, that Main Street and the types of investing you're doing is better than some of the types of investing they may be doing in Wall Street, you're going to need to understand where they're coming from and what they're experiencing and what they believe. Fortunately, the news last year has been very kind to Main Street investors relative to paper asset investors, and I think we're probably going to be talking about some of that today.
Absolutely. In fact, from Yahoo Finance, the first article we have came out at the beginning of the year, and it says 2022 was an unusual year for the stock market. That's their headline, and basically says that the S&P 500 closed down 19.4% for the year, which makes 2022 the worst year for the S&P since 2008 and the fourth worst year since the index was launched in 1957. So that's not to pour salt in the wound, but let's face it, stocks as a whole are way down from last year.
Yes, and it really speaks to the idea that most people believe that investing is buy low, sell high. Most people have become speculators on higher pricing because they think that's investing, and they don't really pay any attention to price to earnings ratio, or what we would call cap rates in real estate investing. They're really focused on, I just want to buy the stock at one price and sell it at a higher price. And if you're the kind of investor that is not paying any attention to dividends and you really don't care about earnings, you're just interested in getting the next hot stock and, making a 10, 15, 20% gain, that's all great when the money is flowing freely and the bulls are running and everybody's excited and piling into the stock market. The challenge is when the tide goes out, as Warren Buffett famously says, then you can see who's swimming naked. And that means who is investing in things that don't have fundamental value, that aren't really producing profits. And of course, profits are also affected by inflation. They're affected by high interest rates, high energy costs, high regulation. There's all kinds of downward pressure on stock operations. So even those stocks that are valued by incomes are coming under some pressure. All of that is reflected in an overall index, 500 stocks represented in the S&P, that has performed nearly 20% down. And as you said, Robert, the worst since the great financial crisis and the fourth worst since the thing started. They started paying attention in 1957.
So what does that mean to real estate investors? Well, obviously, if you're looking to buy property and you're thinking I might liquidate some stocks to buy property, well, your stocks are down. And human nature makes it difficult for us to sell when things are low. But it's always the compared to what? Our friend Rick Rule always points out that when you say, well, my portfolio is down 20%, I don't want to, sell until I'm back to even. His point is, you've already lost the 20%. That's not something that you're waiting for another occurrence. You've already lost that money. So the question is, what do you do with the 80 cents? That's the question. And then I think the other thing, we obviously talk to a lot of folks that raise capital to do real estate investing, and we're going to bounce around all those topics you hit there a minute ago, Russ. But if you're thinking about raising money to invest in real estate, well, there's a whole bunch of stock investors who aren't very happy right now.
Well, I think this is a wake-up call for everybody that has been focused on buy low, sell high. The first phase in readjusting your own investing paradigm or that of your potential investors, if you're a syndicator, is to take a page out of the Robert Kiyosaki playbook, which is cash flow. If you're investing for cash flow, when you realize that equity, real equity, resilient equity is a derivative of cash flow, it's no different than Warren Buffett focusing on real profits. I want to buy companies, he says, that produce real profits and especially produce fundamental or essential products and services that are less likely to go down in difficult times, because his famous rule of investing was, number one, don't lose money. Number two, don't forget number one.
Right.
And so when you understand that kind of fundamental, conservative, long-term investing is based on real value, that is tailor-made for real estate, because real estate meets a essential human need. It is really valued by the income it produces. Its equity is a derivative of the income it produces. And unlike stocks and company and corporate profits, some of which are very sensitive to key inputs, rents tend to be pretty resilient. I'm not saying there isn't downward pressure on rents right now, because the American consumer is experiencing inflation and net loss in terms of their real wages. Their nominal wages might be going up, but their real wages net of inflation are actually going down. So landlords are going to feel that. And of course, landlords are really feeling it with the interest rates. But with all that said, and we're going to talk about interest rates in a minute, the reality is rents have a track record of being very sticky and very resilient. And the reason most people don't invest in real estate is they don't like to get their hands dirty. It's a lot more clinical to be able to invest in stocks and bonds. But that convenience, that liquidity comes with a price. It's called volatility, which is fantastic when it's all good. But in 2022, you see what happens when it's not all good.
Well, and this concept of nominal versus real, it's always hard to get your mind around that. But as inflation erodes our purchasing power, like it has since the dollar was first invented and every currency before it, you have to keep in mind that the stock market is down 20%, but the dollars that are left, everyone is worth less than it was a year ago. So you've actually had a double whammy. Now, we're not just going to beat up stocks. This next article is from CNBC, and it came out on January 7th. 2022 was the worst ever year for U.S. bonds. So the bond market we've heard a lot about in the last year. This says 2022 was the number one worst year on record for bonds, according to Edward McCurry, an investment historian and professor emeritus at Santa Clara University. And they say that's largely due to the Federal Reserve raising interest rates aggressively, which clobbered bond prices, especially those for long-term bonds. So I think no investor left behind. You have to understand how bonds function in accordance with interest rates.
Yeah, it's really common sense, and you can do it with some real simple math. And if you go way back to the beginning of 2020, when we recorded the crisis investing series as the economy was shutting down, and we said, here's what's going to happen. Our thesis was we're going to have this health crisis, which is going to shut the economy down and create an economic crisis. And in the process of doing that, the debt is going to go bad, and it's going to affect the currency. And I think still all of that is playing out. What happened is there was a lot of stimulus to spike the economy when everything was shut down. So when you have a lot of purchasing power added to the economy, but not a lot of production, in fact, production going offline, that tees up extreme inflation. And you go back and listen to the people that were paying attention, understood the mechanics of the way the economy and the financial system works. It was pretty apparent we were going to have inflation. The question was, would the Federal Reserve raise rates aggressively to battle the inflation, or would they focus more on increasing production? Well, we had the changing of the guard in the new administration. The first order of business was to shut down the Keystone Pipeline, created tremendous energy inflation, cost a lot of good manufacturing jobs, had a trickle effect. And again, we're not throwing any administration or political viewpoint under the bus, just telling you what happened. And so the result of all that was that the battle of inflation had to be fought on a monetary basis, and the Fed aggressively raised interest rates. We're going to talk about that in a minute. But the way bonds work is the same way like apartments work. So if you understand apartment investing, when cap rates are going down on the same rent, it means that people are bidding the price up. So if you buy a property, say at a 5 cap, and cap rates go to 3 and your rents don't change, people are paying you more for the same income. So that's good. You got equity. If you're a buyer in that market, it's bad because you're paying more for the same income. So it isn't good or bad in and of itself. It just depends on which side of the equation you're on. Well, bonds work the same way. The price of a bond, the value of a bond, is a derivative of its yield. So in an environment, like say, if I bought a bond for $100,000 and it paid a 5% coupon or a 5% yield, it would throw off $5,000 a year. If interest rates went to 10% in the open market and I wanted to buy that bond, I'm not going to pay $100,000 for it, because it's only throwing off $5,000. If I wanted to get 10% yield on my capital, I would only pay $50,000 for that bond. Now, there's some other factors. That's not a precise analysis, but just understand that rising interest rates take existing bonds and drive their pricing down. And most of these bonds were issued when interest rates were at record lows. Now, in some cases, interest rates have doubled and tripled, and that really has crushed bond value. So a typical stock and bond portfolio, the 60-40 split that financial advisors have recommended since forever, got crushed on the stock side and got crushed on the bond side. And this is why.
Just like a cap rate, it depends on when you bought it and what you paid. And that's a big part of it. But because most of these bonds were originated at low interest rates and interest rates have gone up, ouch. We've got more clues in the news. We're talking about what's happening in the economic world and what it means to real estate investors. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from May 5th through 8th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 18 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful, the people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. There's all types of opportunity in Belize when it comes to real estate investing, including both long-term and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me May 5th through 8th in Ambergris Caye, Belize, as we study the market, learn about sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so you can follow up with them after the trip if the market is interesting to you. You've heard about Belize and the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, May 5th through 8th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events, and I look forward to seeing you in beautiful Belize.
Hi, this is Mauricio Raul, the founder and CEO of Mir Law Group, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Heard every weekend on this great radio station all the time at realestateguysradio.com and your favorite podcast outlets. It's clues in the news, what's happening in the new year, and what it means to real estate investors. This next article, also aggregated from Yahoo Finance, originally on NerdWallet, 2022, the year of stunning interest rate increases. This came out just before the end of the year. It says, when we rang in the new year, in January of 2022, we were coming off 3 full years of no rate increases from the Federal Reserve, and it showed in our savings accounts where some of the best rates were really low, barely reaching 0.5% annual percentage yield. A lot can happen in a year. In response to inflationary economic conditions, the Federal Reserve increased the federal funds rate multiple times throughout 2022, clocking in at 7 increases through December 2022. Now, the best high-yield savings accounts are earning upwards of 3%. So, the angle here is for people that are putting their money in the bank and getting an interest return. So if that's you, if you put stacks of cash in the bank and previously you were getting 0.2% and now you're getting 3%, well, I guess that's good news.
Well, and so this really now comes down to understanding what your alternatives are and understanding the risk that you're taking. So obviously the interest rate increases created one set of problems, and that was anything dependent upon cheap money for its asset price valuation, and real estate's on that list, saw pricing come down. Cars have seen pricing come down. Anything that you were going to finance, your cash flow, your monthly payment was not going to go as far because more of it was being sucked up in interest expense. So we kind of all understand that. This article is taking it from the other side as an investor. Yeah, but you're getting higher yields. Yes, but what are you really getting? If you're investing in bonds, to the discussion we were having before the break, you're taking tremendous principal risk, because if you buy a fixed rate bond, especially one that's fixed for a longer period of time and rates go up further, your bond principal goes down. So that's risk. A lot of bond investors don't understand that risk, but they've discovered it after 2022. The flip side of it, if you put your money in the bank, you might say, well, gee, I'm getting 3%. However, you have counterparty risk because your deposit is really a loan to the bank. They owe you the money, and you literally are an unsecured creditor. If your balance is less than $250,000, of course, it's guaranteed by the FDIC. But if you have larger balances than that, it can be a bit risky to put your money in the bank. And so you say, well, gee, what would the alternatives be? Well, one of the alternatives would be a private mortgage, because this would be a way for you to get a higher yield and you don't have the same level of risk. And we'll probably talk about that a little bit more in a moment. But interest rates were a big, big story in 2022. And the ramifications of those interest rate increases have yet to be felt completely. And as of January of 2023, it's not clear that the Fed is done. It's likely they're going to continue. Now, they may have moderated. They were going from these 75 basis points or 3/4 of an interest point hikes per session down to half. Maybe they'll drop back down to 25 basis points or 1/4 of a point. But the tea leaves, and a lot of people paying attention are thinking that based on the Fed's comments and where inflation is at, and we're going to talk about that in just a moment, the Fed is probably going to have to continue to tighten. So the result is going to be more interest rate ramifications rippling through financial markets and the economy, and that's going to show up in stock prices, real estate prices, car prices, corporate profits. The list goes on and on. It's the price of money, and it's a very, very important factor to pay attention to.
Now, keep in mind the federal funds rate does not determine all interest rates. In fact, as we saw those increases this article speaks of throughout 2022, a couple of times we had, 0.75 increase and all of a sudden mortgage rates went up. And another time we had a 0.75% increase and mortgage rates went down. It does influence rates and advises rates, they say. So as we see the Fed funds rate continue to go up, we can expect to pay more for credit. But just understand, it's not a one-to-one relationship.
No, the Fed actually doesn't set interest rates in the marketplace. What they do is they set targets, and they basically are signaling to the marketplace in which direction they are going to intervene. It's not conspiracy theory that the Federal Reserve intervenes or manipulates markets, especially the cost of money and bond markets. It's well known. They have the FOMC, which is the Fed Open Market Committee and Open Market Operations. And what they do is they go in and buy and sell bonds. And depending on what they bid and how much they buy, they either bid up the price, which takes down the rate, or they sell into the market, which creates more supply, brings the bid down, which drives the rates up. So when they come out and say, hey, we're going to do this with interest rates, they're signaling to all the market participants the direction they're headed. They combine that with their forward-looking statements, their guidance, if you will, and then usually in between sessions, they'll have various Fed governors come out and make comments, and there's a lot of jawboning that goes on that tries to manipulate the market participants to behave in a certain way. Doesn't really affect real estate investors as directly as it does paper asset investors, stock and bond investors. However, as stock and bond investors make moves, it does affect the interest rates in the mortgage markets, which are a derivative of what's going on in the financial markets, the credit markets, the bond markets in particular. And so it does have an effect, which is why we pay attention to it. I think one of the great advantages of being a Main Street investor and investing in real estate and mortgages as opposed to stocks and bonds is that you're insulated from a lot of this, and the asset classes we invest in move much slower, so you don't quite get the volatility. You have more time to read and react. However, you're not invincible. You're not invulnerable. And I think 2008 showed that, at least to me personally, in very, very real terms. I used to not pay attention to any of this. And 2008 taught me I'm not invulnerable. I'm not isolated from it. It's just it trickles down. And I do have time, but I got to pay attention, which is why we do shows like this to help you pay attention.
So what does it mean to real estate investors? Obviously, money is the fuel we use to buy real estate. If we don't buy for cash, we use leverage. And if interest rates are up on loans made to real estate investors, that's going to affect everything. Here's an article from CNET on January 17th. With the mortgage finance rates for the last 7 days, and it says the average rate nationwide for a 15-year fixed refinance decreased over the last 7 years, while the 30-year fixed rate refinance rate increased. So it just brought to mind that it's not an absolute. We've seen interest rates come up. They've come down a little bit, But depending on who you pay attention to, there's a lot of sentiment that we're not going to see substantial decreases in real estate mortgage interest rates this year. Now, nobody has a crystal ball, but if you're waiting for rates to get down in the 3 and 4%, you might have a really long wait.
Well, you have to look at it in context, just like we look at wages net of inflation. You have nominal wages, which is the number, and the number goes up. You go, gee, I'm making more money. But then you say, well, yeah, but I got a 3% pay increase, but inflation was 8%. Therefore, really, my real wages went down 5%. Well, the math is the same when you think about the cost of money with real estate. If inflation is, say, running 8%, which, oh, by the way, it is, and the mortgage rate you're paying is 6%, you're actually getting paid to borrow. You're still a net negative. And so you could go back and say, yeah, but I used to be able to borrow at 3%. Yes, you could, but inflation was 2%, so you were plus 1. So which money is cheaper? Well, it depends. And so there's a lot of this going on right now that people aren't aware of. And of course, the thing about interest rates, and you taught me this, Robert, is you get a chance to negotiate the price of the property once. But you can change the interest rate or the loan as often as you want, depending on what's going on in the market. Obviously, if real estate prices are going down because of increasing interest rates, and you have people who are hesitant to make decisions because there's uncertainty in the job market and inflation, then you have a chance to buy a property that maybe was previously selling at a higher price, a good quality property in a nice neighborhood or whatever your criteria is, and you're able to lock that price in based on temporary situation. And when those temporary situations change, let's say that we get better employment, we get lower inflation, we get cheaper interest rates, then that equity wave that happens as a result of that, you already have the property. Now, we're not here to tell you how to time the market, but if you're going to buy a property and it makes sense at the moment you buy it, you say, gee, if nothing changes, I can live with this, that's pretty good. If interest rates go down, great, you're going to be able to refinance and you're probably going to see some equity. If interest rates go up or credit markets collapse, you may be happy that you locked in the rate that you have or got a mortgage when you could. Real estate, if you're doing it right, is probably a long-term game. If you're flipping properties, it can be a little scary, right? If you're going to be in and out in a year or two or less. But if you're talking about buying a property you're going to own for 5, 10, 15 years, then what really matters is the market, the overall trends in the market, and your ability to control it for the long haul and manage it for positive cash flow during that term. And whatever happens to the price is really interesting during those 15 years, but it only matters at the beginning, when you do a refinance, or at the very end. The rest of the time doesn't really matter.
You know, when we started working together 20 years ago and you were in the mortgage business, rates were like they are now, maybe even a little higher, and investors had a choice. They could get a fixed rate loan, but many chose to get an adjustable rate mortgage, and that was because it was easier on the payment, knowing full well that those rates might adjust. I remember being in many of those products that actually went down over time. Now, in the last 5 years, no one's really talked about adjustable rate mortgages because fixed rate mortgages have been so low. But in the last 6 to 8 months, all of a sudden, adjustable rate mortgages are back and growing in popularity. Now, I bring that up because an article that came out January 13th on Realtor.com says almost half of home buyers who took out an adjustable rate mortgage regret doing so. This is actually from a survey done by U.S. News and World Report that 43% of those that took out an adjustable rate mortgage in the last 3 years regretted it. So are we back to a time when we're going to consider getting an adjustable rate mortgage, knowing that it'll save us some money up front, but has the risk of going higher?
I think you need to look at the macro trend. We had 40 years from the big interest rate reset in the early 80s under Paul Volcker, who was the Fed chairman back then under Ronald Reagan. And in order to crush the inflation of the 70s and break the stagflation that happened in the 70s, Volcker had to take the prime rate up over 20%.
Yeah.
My first investment property, my mortgage was over 13%, but it was still positive cash flow. So again, it's all relative. But that was a 40-year downward trend in bond prices, and we hit the zero bound about 10 years ago. And we stayed there for 7 or 8 years. There was a couple of attempts to get the interest rate up, and they failed. And it really took this crisis and very high inflation to get the Fed to really aggressively come out. Because again, as I said earlier, increasing productivity, which would be the other way to subdue inflation, isn't in the cards under the current policy. So that meant the only thing we were going to get was monetary policy to try to mitigate inflation. So I think there's still a lot of pressure on rates to go up. I don't think there's a lot of pressure on them to go down. In the short term, I think ultimately they're going to have to go down. But I think all the pressure is actually going to end up on the currency. And so this is no secret for anybody who's been listening to the show for a long time. One of the things that I've been concerned about for the last 10, 12 years is how long the dollar can really retain its dominance in global trade when China and Russia have overtly conspired and worked together to undermine it. And now that the dollar has been printed in, not into oblivion, although some people could say that is coming, it's certainly been diluted, and that's why we have inflation in U.S. dollar terms. The question is the dollar going to survive this? So part of your investment strategy is not just what's going on with interest rates, but what's going on with the currency. So we don't have those answers right now. We hang out with a lot of smart people. We're going to convene a whole bunch of people. You know, the big guys are all in Davos right now talking about how they want to manage your future. And we're going to get together at the summit in Belize this summer, and we're going to be talking about how we're going to work to stay free and mitigate all the different changes that are going on in the marketplace. But you can better believe the future of the dollar and the future of interest rates are going to be a big topic of conversation at our conference and other conferences we attend, and probably should be something everybody listening to this should be paying attention to in 2023. Pay attention to the dollar, pay attention to interest rates. It'll give you guidance in terms of where you might go to find opportunity or where you might want to go to find safety.
Today, we're paying attention to what's in the news, clues in the news, more headlines when we come back, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
Hey everybody, it's Ken McElroy and I'm on with the Real Estate Guys, and I'm very excited to be a guest and a speaker at the Investor Summit on the Sand in Belize coming up. If you haven't signed up, be sure to do so.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Isn't it time you got registered for the 21st Annual Investor Summit on Sand? It happens June 6th to the 14th in beautiful Ambergris Caye, Belize. We've got a world-class faculty and limited space. Get all the details on the website at realestateguysradio.com. At the top of the page where it says Summit, it's clues in the news, what's happening out there in the world and what it means to real estate investors. Before we get back to the headlines, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's real estate trivia question. When you hear the question and think you know the answer, send your best guess to trivia@realestateguysradio.com. First person that gets it right gets a brand new awesome book hot off the presses, just hit #1 on Amazon in more than 15 categories. It's called Next Level Your Life, inspiring stories from lots of awesome folks. Our friend Simon Bailey's in the book, Navy SEAL T.C. Cummings, Courtney Muller, Jay Johnson, yours truly, and our great friend Tom Ziegler. Find out more at nextlevelyourlifebook.com. That can be yours if you know today's real estate trivia question. Last time around, we were talking about delicious profits with international agriculture. We asked this: where in the world is the most cacao grown? Well, it's grown in lots of places in the world, but #1 region, the Ivory Coast on the southern coast of West Africa. Chocolate lovers of the world unite. Here's our real estate trivia question for this week. In the upper hemisphere, it's winter and things are kind of cold. There's been some snow and some storms. Here's the question we have for you this week. Which is the coldest state in the U.S.? Yeah, with regard to average temperature, which is the coldest state of the 50 states in the U.S.? If you think you know or you just want to guess, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. We'll need your name, the answer to the question, and your physical mailing address so that if you're the winner, we can send you this awesome brand new book, Next Level Your Life, put together by our good friend Kyle Wilson. That's today's real estate trivia question. It's clues in the news. We're taking a look at the headlines and what that means to real estate investors. We've been talking a little about inflation. Here's an article that came out from Statista January 12th. 2022 inflation tops previous decades. It says with the December release of the Consumer Price Index by the Bureau of Labor Statistics today, the final tally for 2022's monster inflation is in. Inflation cooled towards the end of the year with last month's year-over-year price increases standing at 6.5%. Yet 2022's average inflation in the U.S. still adds up to a gigantic 8%. Looking at the previous 3 decades, no year saw inflation quite like the last one. Now, it's interesting what happens, human nature again, when gas went up to $6 a gallon and people are like, oh my gosh, it's insane, it's crazy. And then it went back down to $4.50. People are like, oh, not bad.
I just actually had that experience driving back from the Create Your Future event. We drove through and we saw gas at like $3.35 and said, oh, that's cheap. Like, I remember when the little memes were coming out with $3 gas and it was arm, leg, and firstborn.
Right. Yeah. No, it's what we get used to. So when inflation was 9, now we're going, oh, well, inflation's only 6.5. That's not too bad. Well, yes, it is. It's terrible. You have not lived through 6.5% inflation too many times in your life, no matter how old you are. The Fed's target rate is 2%. But again, they only influence, they don't control. And so for a myriad reasons, we're seeing tons of inflation. 2 years ago at the Investors Summit, when inflation started to rear its ugly head, there was a lot of talk about it being transitory, of course. We had Dr. Doug Duncan, the chief economist of Fannie Mae, with us for the summit, and he said, I don't think I would count on it being transitory, at least not all of it. And as we see, they don't even use that word anymore.
No, I think they ended up being embarrassed because they came out so strongly poo-pooing the idea that it was going to be sticky, that it was going to be persistent, and it turned out to be both of those things and worse. And then all of a sudden they hit the panic button and started aggressively hiking rates. And so it's like a car fishtailing on an icy road, and you start overcorrecting and things start to spiral out of control. So it's nice to see things starting to moderate a little bit. I think that the Main Street workers, business people, and consumers are fairly resilient. They adjust. We obviously, if you're paying attention, you've seen shrinkflation, portions getting smaller at restaurants. I've noticed packaging and products on the shelf at the grocery store changing so they look the same, but they don't have as much value engineering going on in all kinds of projects, trying to shave costs here and there. And that's kind of the insidious effect of inflation as people are trying to adjust. Obviously, the flip side of inflation is nominal wages go up, rents go up, interest rates go up, which if you're on the charging of interest rates and getting paid, can actually help increase your income. So there are winners and losers in any type of an environment. It isn't a matter of saying, oh, inflation is good or bad. You can make the argument societally. On the macro level, it's bad, but it doesn't have to be bad on the micro level. At the individual level, if you can see what's coming and you understand how all of these things are interrelated and how they're likely to affect your portfolio and the assets that are out there and which markets in terms of product niche demographics and geographic markets are going to be affected, good or bad, then you can position yourself to take advantage of the opportunities that are created, mitigate the risks that are created, and do better than average, or in fact, a lot of cases do quite well. So just because the news is bad, or at least presented bad, understand it creates a lot of opportunity. We talked about this with our syndication club the other night because these types of headlines create a lot of fear, uncertainty, and doubt. FUD is what your dad used to call it. Fear, uncertainty, and doubt. And the reality is when you're wanting to sell something, if you're selling an investment, for example, and recruiting people to come into a project you're doing, fear, uncertainty, and doubt makes them prone to be looking for wisdom, to be looking for options and opportunities to change. They get upset with the status quo. And so if people are not happy in the stock market, if they're not happy in the bond market, if they're not happy with the yield on their investments, and you begin to explain to them that even some of the places they go for safety come with some counterparty risk and some other risks they might be aware of, and then you show them viable alternatives on Main Street, investments they understand, and you have the ability to articulate to them why your particular investment or investment thesis is more likely to do well based on the current conditions, you can probably win funds. You probably get some capital to come your way. And of course, even if you're not syndicating and raising money from private investors, you really ought to do this type of analysis for your own portfolio. You know, a lot of people in the real estate space like to just do deals. They go from deal to deal to deal, and you can make a lot of money. You can stack up a nice portfolio. The problem of being deal-oriented and not looking at your portfolio is when these macro factors, which have portfolio ramifications, happen, you have a hard time seeing whether your portfolio is well-positioned or vulnerable. And so having a portfolio paradigm can be helpful, especially when you have these kind of changes going on.
You know, in this article, there's a chart of inflation from 1990 to 2022. The highest year in that entire period of time was 1990, just over 5%, and we're now at 8%. In 2009, inflation was negative for the only time in that 32 years, and that's because we were on the heels of the great financial recession and prices actually came down. Remember that, to your point, Russ, it's not all bad news. One of the places inflation has showed up is in rents. Rents are up. So, yeah, interest rates are up, but rents are up. So you got to do the math, and the math will tell you what to do. You may not want to pay 6.5% for a mortgage, but if the rents are up enough, it may still work. It's Clues in the News. We're talking about the headlines. We've got more when we come back. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, I'm Steve Forbes. You're listening to The Real Estate Guys. Listen up.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you have a question for the Real Estate Guys, we have an upcoming edition of Ask the Guys designed just for you. Just go to the website at realestateguysradio.com and click the button that says Ask the Guys. We'll take a bunch of great questions and answer those coming up. Today we're talking about clues in the news, looking at different headlines. Here's a headline that came out January 5th on Yahoo Finance. Layoffs are sweeping corporate America to kick off 2023. Fresh job cuts are in the works already at Amazon, Salesforce, Goldman Sachs, and Vimeo, and more. It lists lots of different places where we're seeing layoffs across the board.
Yeah, I think that for people who are out there recognizing that when inflation creates weakness in purchasing power, people are selling less products, their input costs are going up in terms of energy, to your point earlier, rents. Of course, there's more regulation than there used to be, and more regulation coming. We've got a lot of agenda around cleaning up the environment. Again, I'm not saying any of these things are bad, so don't get me wrong, but they do have an impact, whether you're supportive of the initiatives or not. Part of that is that corporations are trying to tighten their belt, and labor is one of their biggest expenses. And when you see major companies like Amazon, Salesforce, Goldman Sachs laying off. In fact, Goldman Sachs just announced recently some severe losses, and part of that is loan loss provisions. Banks, lenders are beginning to make provisions for more debt going bad, kind of a throwback to 2008. And so when you look at these major players that are looking out on the horizon, that are looking at their exposures and their credit portfolios, meaning they're not owing the money, they're owed the money, and they're making greater provisions for loan loss, that's an indicator that there's some weakness out there. The flip side of that, of course, is that if you're one of those people that are laid off, you might look at it as a gift. It gives you the opportunity maybe to start a business, maybe to start a new career, maybe find a better job that you were procrastinating looking for. And so that may be an opportunity for you. The other thing is your retirement account comes available. You can roll that over from the company 401k to a self-directed IRA or a solo 401k, depending on what you're doing. In fact, we've got a friend of ours, Damian Lupo, who wrote a report about all that. I think you can send an email to QRP, like Qualified Retirement Plan, at realestateguysradio.com to learn more about that. But that money can be made available to you. And if you choose to become an income investor, you can invest in mortgages or cash flowing real estate. You may be able to produce some significant income from your portfolio that offsets some of the income you lost in your job, even if you have to take a job you like better but doesn't pay as well if there's some softness in wages. Of course, if you're a syndicator, there's the opportunity to help those people place that money and make those investments, or if you're looking to start a side hustle or create a business of your own, you might take a look at syndication. It's a great business. There's going to be a lot of Main Street assets coming available, a lot of money looking for a home, trying to escape the volatility of the stock market. I would love to have you come out to our Secrets of Successful Syndication and learn what that's all about. That's coming up soon.
Into March in Dallas, Texas. You can get the details by sending an email to syndication@realestateguysradio.com. Another point in this article is that a lot of these layoff announcements are coming as U.S. companies grapple with inflation, higher interest rates, and a deteriorating economic environment. So companies make their decisions, and obviously this is going to affect you as a real estate investor if you have a lot of tenants. So you want to be paying attention to where your tenants work and what industries they're in. I think that the pandemic taught us that we need to be diverse in our tenant profile for sure. But there's another point to it. Look at what happened to Southwest Airlines. It started with weather, but it got a lot worse than that. And trust of that airline is down. Their stock price is down. Employee satisfaction is way down. There was an article that came out the 16th of January. Southwest Airlines has a problem bigger than its technology, and passengers should be very concerned about the message being sent by the airline's pilots. So the pilots got together and went on to say that the new management had made decisions as to where to spend their money that didn't favor the employee. And they were doing stock buybacks and all these things instead of investing in their archaic systems that are now failing. So it's just a decision. It's not to pick on Southwest. I've flown them more than 2,000 times. Russ and I both had companion passes for 3 or 4 years in a row. That's how much time we spent on Southwest. But the point is, when you make a decision like that, we're going to lay off people, then that's going to have that economic ripple. And all of the things we've talked about today are converging. That's why we're doing this show. Yeah, interest rates are up, but that's not in a vacuum. People's stock portfolios and bond portfolios are decimated. Real estate is held pretty strong. We haven't talked about precious metals, but they're up in the last couple of weeks and substantially, as are the cryptocurrencies. So the idea of paying attention to the headlines is so you can get a heartbeat of not only what's happening in the economy, but this is a big point, how people are perceiving it.
Yeah, well, you talked about Southwest Airlines, and that's really a example of a bigger macro trend that has taken some of the air out of the stock market, and that is when the Fed was putting cheap money in the marketplace, a lot of corporations were taking that cheap money, and because the money was so cheap, they could make a higher return by buying back their own stock than by making investments in growing their business, their productivity, taking care of their employees, growing their market share, and improving their profit margins. It's like when you go to a professional money manager on Wall Street and you realize they make more money selling new money than they make managing your money for profit, because they make money whether you win or lose, right? So you have to look at the moral hazard that is created by the policies, both corporate policies, Federal Reserve policy, which is monetary policy, government policy, which is regulations and taxes and spending. And you look at all of those things to try to get a feel for what's going on in the macro, and then trickle that down to wherever it is you're investing and how it could affect you, good, bad, or otherwise. And then you just need to make those adjustments. That's why it's really important to be part of a mastermind where other people who are studying these things are bringing their ideas, and you're sharpening your understanding by talking with other people about it.
There's a lot to pay attention to, but it's worth it if you make the right moves because of it. Next week, we're going to hear from you. If you have a question for the Real Estate Guys, go to the website at realestateguysradio.com and click Ask the Guys. We'll hear what's on your mind next week. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors. From attorney and rich dad advisor Garrett Sutton.
Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.